the fundamental analysis and its importance in our trading. All right. First of all, I'm going to show you what we do in our Slack community. I don't know if you guys are premium members or not, but I'm still gonna show you because this webinar is going to be recorded. And well, this is the Forex channel I oversee. I am the Forex guy at Tradimo. And well, basically, what we do here is we share charts, setups, trade ideas. More often than not, I mean, we make a few pips. This chart started 2 weeks ago, and we are up 461 pips on our trades. The last trade that we closed was a 161 pip trade on the GBP, the yen, and here we closed half of that trade at a 261 pip win for a 261 pip win, right? Yesterday, guys, because well, I'm going to show you the chart. The chart speaks more than words, right? So let me see. This is the GBP yen. Let's just wait for it to load. All right, I'm going to um, zoom in it. So basically, we entered the trade right here at about 147.44, if I'm mistaken, and we close half of our position here at this. So we made 261 pips, and well, the GBP against the yen was trading inside of this continuation pattern. But yesterday, I didn't like the price action, and I didn't like the fact that we couldn't close below 144.70. So I decided to close half of the position here for a 261 pip win. That's a lot of, I mean, that's a lot of pips. If you were trading one lot, that's 2,600 pips, $2,600 just in one trade. And we move our stops above these highs, right? And we move our stops above these highs because if price, I mean, if price couldn't close below the 147.44.70 level and broke with the previous highs, well, the short bias was sadly over, and we should be closing our position with a win, of course. There you go. This is what we do on the premium. And if you are not a premium subscriber, I'm going to give you this little gift. All right. So let me just grab this tool, and if you go to our premium subscription channel, page, and you use this voucher, I'm going to give you the first month for just $1. All right. So all you have to do is enter this voucher on the checkout box, right? And you will be discounted of $48 for the first month, and you can try our services for just $1 for 30 days. So that's a great offer that I have for you guys. And let's get started with the webinar, shall we? So what we're going to do, I thought about a couple of ways that we could be doing this, and one way that we can do this is just talk about what happens when, right? But then I thought to myself that that was not that educational, and I thought better to use an actual economic calendar. All right, so I'm going to cut my screen in two. On one side we're going to have the charts, and on the other side we are going to have the economic calendar. All right, so let me just close our Slack channel here. That's right. We're going to get our chart in here, and a new window for our calendar. Now, we have an economic calendar at Tradimo that you can use, but I need I need to show you what happens when starting of the data that goes out. All right. We're going to look at the US dollar. All right. We're going to look at the US, and whenever we look at a high impact event, I'm going to show show you what happened with the US dollar and why the US dollar moved the way it did. Is that cool with you? And of course, because you are only three, there are only three attendees, you need to make the best out of this and just ask away. Chat open here. If you have any questions, just ask away. I'll cut the explanation and answer you guys. I mean, take advantage of this intimate session that you have with me, right? Okay. I'm sorry, I just took a sip of my coffee. All right. So, high impact events. We're going to have a look at the last few weeks. All right. And we're going to high impact events. Oh boy. Let's look at this month. Okay. It's fine. It's going to be fine if we look at this month. Let me just have filters, all currency, all type of events, and well, not speeches. Just yeah, we're going to look at growth, inflation, employment. Yeah, we're going to look at growth, inflation, and employment. Enough data for us to analyze with the charts. So we're going to apply these filters. And we're only going to look at the US dollar. I might as well cut out all the other currencies, right? Or should the euro and the GBP too? It's up to you guys. I say that yeah. I mean, we look at the dollar. All right, so the US dollar, the euro. All right, that's gonna be fun. All right, there you go. Now, the importance of fundamental analysis or global macro, as it's called, is that I mean that is the impulsive a move or a long-term move in the currency markets. All right. So basically, what happens is the central banks make decisions of monetary policy, and based on those decisions and the economic outlook that they put out, the currencies move the way they do. For example, if a central bank looks at for example, the Fed, that's the central bank in the United States, um, looks at a economic or at a weak U.S. economy, right? It's going to be more dovish in its economic outlook. For example, it's going to increase its assets purchasing program, and it's going to stop its hiking of the interest rate. All right, it's going to remain. It's going to maintain the interest rate around zero. And if not, if the looks at a growth in the U.S. economy, in this case the Fed, they're going to start to decrease their asset purchase program, and they're going to start hiking that rate because the asset purchasing program, it's inject money into the economy without being too taxated on inflation. All right, and the and the when well, this is what happens, right? The central bank buys assets from commercial banks for the commercial banks to have more liquidity, so the commercial banks can liquidity and to the industry, so the industry can create more jobs, and by creating more jobs and increasing wages, these people, well, the people can purchase more goods. So as you can see that by the central bank buying assets from the commercial banks, it actually makes the economy to start running more smoothly and to grow, right? And that's why the central banks have these QEs, right? And when the economy is starting to look better, and you see better inflation numbers, better housing numbers, better employment numbers, then the central bank can decide to lower the asset purchasing program for the to the commercial banks because the QE is working, right? They need to ease that QE, and because of all that is or behind this is why the US dollar moves the way it does. For example, let me show you the US dollar on a higher scale, right? Let's go to for example a weekly chart on the US dollar. So you can see that when here June 12th, June or March 17th. Well, we actually have a higher. This is good. Right here is when the Fed decided first it was going to start easing its asset purchasing program or its quantitative easing, right? So what happened? The US dollar soared because what the Fed was saying is that they saw an improvement or a growth in the U.S. economy, which meant that their QEs, that their quantitative easing was working or had worked, and they're going to start to scale it down. All right. So because of that, the market reacts the way it does. All right. Buyers jump in, and the dollar moves up. And this is why I mean trading currencies can be a little tricky, right? Because yeah, I mean you can trade currencies on the lower time frames and just base yourself on analysis, or you can just trade these events one by one. But really, if you want to be a profitable forex trader, or at least that is the way I do it, guys. I mean, I just check my bias, look at what has happened, and look at the central bank reports, etc. And I take a bias on the currencies. Um, I take a bullish or bearish bias depending on what has I mean on the historic output of the central banks, and then I decide. I mean, I don't trade against that bias. If my bias is a bullish, I'm going to buy the dollar, perhaps by selling the euro US dollar or selling gold, etc. Right? I need to first have that bias in mind. Again, if there's any questions, just shoot them and on the chat. I know that this can be a little thick, but if you understand it, I'm very happy with it because that means that I was able to explain myself in English, which is good. All right, so let's go to the 4-hour chart. And let's have a look at the what happens here. The non-farm payrolls. When was that? On Wednesday. All right. So let's go to I don't know. I mean, it has to be right. March the 6th. What happened? Um, do you guys know if there's a like a command to go to a specific date on the trading view? But if not, I can do it manually. That's fine. March 6th, right? February, March. That's February, dude. March 6th. Okay, this is March 6th. So basically, I'm going to put some vertical lines. March 6th right here. All right. So this is a very big spike on the US dollar. What happened here on March 6th on the US dollar? Actually, what we're going to do is we're going to look for big spikes on the chart, and then we're going to go to the economic calendar and right. So on March 6th, we had the non-farm payrolls. The non-farm payroll change is the amount of new jobs in the U.S. economy in the previous month, and that's a very big. I'm sorry if there is a back noise, guys, but they're doing some labor or they're just doing some work um, on the house next to mine, and there is nothing I can do about it. So I apologize for that. Okay, so basically, the non-farm payrolls are are a very important event, and but these are the ADP non-farm payrolls or the US dollar. So that's fine. So basically, the non-farm payrolls are the amount of new jobs that were added to the U.S. economy on the previous month, and that is a very big deal, right? It's a very important event on the United States, and it moves the market. I mean, I have seen 200 pip move in 50 minutes just because of non-farm payrolls, right? And I have also seen, people get ticked out. For example, I'm going to show you here. I think this is non-farm payrolls. This is March, what, 12th? March 6, March 7, 7. No, I have seen movements. Because the non-farm payrolls come out with another supplement data, and sometimes that data is mixed, and you have people going long and getting ticked, going short and getting ticked out before the market moves. It's very difficult. It's very difficult to trade such an important event if you don't have a live squawk for a minimum, right? You can't be just looking at economic calendar, refresh that economic calendar, and jumping in on the market, because you're going to burn money if you do that. So let's have a look at the monetary policy statement, the ECB press. No, that's on the euro. Right here, the non-farm employment change. Right, that's on March 8th. So we are going to move this to March 8th. The coordinates, the visibility, the alert. All right. So nothing works. Let's go to March 8th. Right here. And we are going to go to the hourly chart. Let's see, the 4-hour chart is just way too big for us to differentiate the actual moves. All right. So basically, we had right here on March 8th the non-farm payroll change. Yeah, I remember this one. This was the actual candle. All right, this bearish candle right here. Okay, so this is very interesting, guys. Okay, so we had a previous number. This was if this is March, uh, the previous number was the amount of new jobs added to the U.S. economy on January. The forecast was for 180,000 new jobs added, and the actual number was 20,000 new jobs added. Now, that's a huge miss, if you ask me. All right, and that's a huge difference between the previous month and the actual month. So what happened is that we had this candle right here. Okay, we had a very bullish move, to the downside. Okay, but after that, Momo traders gave up on their gains, and price started to move up. And what happened is that people started with this strength, right? Regardless of the bad number of new jobs added to the economy, which is a mistake, because you are never going to trade against such bad numbers. And what happens on the days after that is that people buying and trying to buy again got caught in bull trap, because the price of the US dollar continued to trade. And if we go to the 4-hour chart, you can see that from the 97 level that we were, it traded down all the way to I'm sorry, let me just go ahead. Right here, it traded all the way down to the 95 level. So yeah, fundamentals are important in the forex trading or in currency trading. So as you can see, this poor non-farm payroll or non-farm payroll employment change was devastating for the US dollar. And basically, people got caught again trying to buy that dip here at the 96.50 level, and again, and boom, we traded down. All right, so let's have a look at this big bad bearish candle, which was on March 20th. All right, let's see what happened on March 20th. Something must have happened on March 20th. Exactly. We had that was gorgeous. We had the federal funds rate decision. Now, the federal funds rate, if you don't know what that is, the federal funds rate is the rate at which the it's the interbank rate. It's not the rate that applies to you. It's the rate at which the central bank lends money overnight to commercial banks. And I mean, if I show you the actual chart of the data, all right, let me see. Let's just wait for it to load. If I show you the actual chart of the data, yeah, you can see that here's where they started in 2008. The interest rate was at 5%, and this is where the Federal Reserve started its quantitative easing program. Again, what's the quantitative easing program? It's an asset buying program and a decreasing of the federal funds rate, and approaching that federal funds rate to zero in order to give the American economy a boost, in order to help out commercial banks have more liquidity and access to almost free money. All right. So they started to decreasing in 2008, and they started to increase their boom, 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 boom. Long story short, in in 2009, they decreased the interest rate to almost zero. I mean, they were in dire straits, guys. And from 2009 to 2000 and well, to December 2015, that's let's see, that's in December 2008. So that's a full 6 years. Uh, the interest rate was almost zero, and the commercial banks had access to free money, and they were being injected with liquidity by the federal government with their asset buying program. After 6 years, the outlook of the American economy started to look better. So the Fed started to the Fed decided to start hiking that rate, all right, to increase that rate, because and to decrease its asset purchasing program. Why? Because they know, the economy, the U.S. economy had improved, and they no longer need it. So right here we are if we fast forward to March 2019, the interest rate is at 2.0%, at 2.5%, um, and they have been hiking it all over. All right. So we had the decision on this day, and not only that, we had the FOMC statement and the FOMC. I'm not going to go. I'm not going to show you the report because it's quite extensive. But I'm going to go through it with you. I'm going to. I know what it said. So basically, yeah, the forecast was that the Fed would keep the interest rate unchanged, right, at 2.5. But what happened here, and what made the U.S. dollar drop so sharply in so short in such a short period, is the actual statement, the FOMC statement. Okay, now before this FOMC day, right? Before this Fed rate, this FOMC day, the forecast was that the Fed was going to hike, uh, to have a one or two hikes this year, and at least two hikes in 2020. Now, when the FOMC statement came out, the Fed said that they didn't see any hikes this year, and just one hike in 2020. So what happens is that by looking at that language, we can we can translate that the economic outlook, or the Fed's economic outlook, is not as good as everybody hoped it would be, or thought it was. and that made the US dollar crash instantly. So this is why it's important. All right, this is why fundamental analysis is so important in currencies trading. And if you have any questions, again, guys, I mean, just ask away. If you're liking what you're hearing, please give me a thumbs up. I sound like a YouTuber, right? But yeah, I mean, I would like to know if what I'm saying is interesting to you, or if it's of any educational material. So yeah, basically, this is how you look at at the fundamentals of forex trading. Okay, and and I mean, the one webinar is just way too short to go into details of what of how to really do an overall analysis, fundamental analysis. But what I just told you about the federal funds rate and the FOMC statement is basically what you should be looking in every single central banks. Yeah, Alberto has a question. How many times for this crash that we are looking when the federal funds? I'm gonna show you. I don't have to tell you. I'm gonna show you the 50. You can see, man. I mean, it was incredibly fast, and it's always this fast. So I'm going to just go full screen for this, and as you can see right here, boom, that's a 50-minute candle, dude. So yeah, it goes very fast, goes very fast. And if if you're trying to trade these events, I mean, you have to have a squawk service, I mean, a news service. And there are news services around that cost only $150 a month, and they're pretty good. I mean, they're like a mini Bloomberg terminal. In fact, they get the news that you get out of the Bloomberg terminal. So I mean, you don't get the access to the Bloomberg terminal, but you get, you get the news, I mean the moment they hit the wires. And but to come back again to the fundamental analysis of currencies. This is what you do, and this is what you need to study in every single central bank of each of each currency that you are trading. Is if you are going to trade the GBP, what I do, and what I do in the premium forex channel every day is just hit you guys with news on the UK right now. The Brexit is affecting a lot the UK's currency, of course. And I hit you with the news on March the 20th. I hit you with the FOMC statement and the actual news of the rate. It's a very complete service because by hitting you guys with this news helps me in my trading, because it makes me dig even deeper um, on the fundamental part of my trading. I don't know if you understand, but it's a very complete service that we offer, guys. And this offer, you're the only two guys that are going to get this offer of $1 per month. But yeah, it's pretty good. And I think we're going to end this short webinar right here. You're more than welcome to take advantage of that $1 for 1 month offer that I just gave you. And if you do, I'll see you tomorrow on the premium Tradimo community on Slack, powered by Slack. All right. And if you have any questions, and if you want to hear more about a fundamental analysis, just shoot us an email at support@tradimo.com that you want more of this content, that you want to know more about the fundamentals behind currency trading. And I'll be more than happy to produce material for you guys. All right. So thank you for coming. And until next time, this was Orlando for Tradimo. Goodbye.